to the SLV ETF, which we know from Blackrock's statement back in February 21, defaulted along with other authorized participants on their mandate to provide physical liquidity when it was demanded by clients of the ETFs.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today's video will feature some interesting comments from Andrew Maguire in one of his recent podcasts, where he talked about something I had never heard regarding silver squeeze in terms of Blackrock and some things that happened with some customer requests from their ETF SLV, which certainly back during that time we talked a lot about. We've talked with Andrew Maguire about. And I'll reach out to him to see if we can get him on the show soon to dig into this a bit more. But I was really surprised, had not heard this before. And here is Andrew Maguire talking about what happened in Silver Squeeze. So I will play this clip and let you hear it for yourself.
And with both direct and empirical evidence that JP Morgan is heavily involved in providing liquidity to all aspects of the global silver market, including acting as a sanctioned authorized participant to the SLV ETF, which we know from Blackrock's statement back in February 21, defaulted along with other authorized participants on their mandate to provide physical liquidity when it was demanded by clients of the ETFs.
Which is certainly interesting. I don't remember hearing about that before. Obviously, there was a lot that was happening. We had the 116 or so million ounces that were allegedly added into the trust. The shares were reported being added. Most folks that I talk with, and certainly myself, find it hard to believe that they actually added that much metal. Later on, a couple months after, the LBMA announced that there was a miscount. Also, that week after this happened, I called iShares directly, making sure that my understanding of how that works, that, hey, if they add shares, that the metal is added. They were unable to produce the audit. Again, iShares is run by Blackrock. I've never heard officially if someone has been able to successfully redeem units of the trust. I believe it's a 50,000 share block that you would have to redeem. But here, Andrew Maguire is saying pretty flat out that some of the customers were requesting that and they were denied, which would on another level constitute a default of SLV. You may have seen the news last week that it reported Bob Coleman had found the GLD trust inserted a clause saying that basically they might not deliver the metal if it's impracticable for any reason, which again is reminiscent of the clauses that the SLV trust inserted into their prospectus the same time Jeff Curry was going on TV for Goldman Sachs saying that it's impossible for there to be a silver short squeeze, and they were inserting language specifically into their prospectus to protect against a short squeeze should they not be able to deliver the metal. So I'll look forward to following up with Andrew to get more specifics about what he's referencing here, but we'll play it one more time just so you can hear it and be clear, because I was pretty shocked when I heard this
statement back in February 21. Defaulted along with other authorized participants on their mandate to provide physical liquidity when it was demanded by clients of the ETF.
Just another reason why I don't invest in SLV. Certainly I do invest in a lot of silver products, but SLV is not one of them. And you can go back, look at some of the videos that we published last year. Won't get into all the details of that, but another interesting comment that Andrew mentions in terms of the leverage of how much paper silver there is to the amount of physical silver that's out there. Certainly a lot of ways to calculate that, but I'll play here what he mentions on that one.
It's worth looking at what Bloomberg assessed as a benchmark at the time of remember the old silver fix ended on, it was August 15th, 2014, and the new fix began. Well, Bloomberg assessed at that point that the global silver market was valued at $5 trillion. That included options, ETFs, etc. Now, as it happened, silver was trading at around $20 at the time, with annual production around, let's just say, a billion ounces, which is very close to current metrics. So let's look how nickel-like the silver derivative market really is at this juncture. Now, divide one into the other, and we arrive at a widely accepted leverage of 250 to 1. In other words, there's 250 ounces of paper silver underpinning each ounce of physical that's been pledged.
So there you see him coming up with a number of 250 to 1. You can look at some of the volume numbers that get traded every day on the COMEX. Some days there's a billion ounces traded in a day, some days even more. And for what it's worth, in the book that I did, The Big Silver Short, where I interviewed 15 other silver experts, Andrew Maguire is one of them, I don't think we got an estimate of lower than 500 to 1. Of course, when you count all the derivatives that I don't even know if the banks could give a straight answer on the actual number out there. Some think the numbers could be even bigger, which is part of the leverage that's added to the system that always made it seem so vulnerable, especially when the Fed is setting new inflation records, or I guess not technically new records by their calculations yet, but combination of a lot of printed money and an over levered paper silver market is really what drew me to silver. So just a couple thoughts there. Interesting comments on the silver market. And again, look forward to catching up with Andrew and see if we can get him to talk a bit more about that. As we start off the week here was a story I saw Sunday night. Look for more selling pressure in the week ahead as investors learn the hard way not to fight the Fed. Certainly, you had the 75 basis point rate hike last week, and with many calling for 50 or 75 basis point rate hike in July, certainly that would lead to some selling pressure. Although adding on to that, we see a story here from Zero Hedge. Swiss National Bank hikes rates for first time in 15 years, warns it may sell billions in stock. And here's the interesting part, implicitly signaling the potential for further foreign asset sales to strengthen the franc. This is a problem for US stocks because of the bank's latest 13F filing shows it owns some $177 billion worth of US stocks and hundreds of billions of other securities. So that's something I think people had become aware of over the past decade if you're following these things closely, although perhaps some people completely unaware that the Swiss National Bank was actually printing money to buy US stocks, which would seemingly be not in the best interest of the own Swiss citizens, and just shows that even the currencies that have traditionally been viewed at times as the real safe havens also subject to the current central bank mania of printing money. And one other note about the Swiss franc that some of you have heard before, but perhaps is worth mentioning again, is that it was back in that first week of September of 2011 when gold was up around $900 then. It was Labor Day weekend. The Swiss announced that they were worried their currency was rising too fast, so they were going to peg to the euro. Chris thought that that might send gold surging through $2,000 that night. Instead, you saw a massive block offer smash the price. I believe it was 50 or 60 bucks lower, which certainly was one of the events that led me to begin thinking there might be something not above board about the gold and silver markets. My background as an equity options trader, we were specifically trained never to execute an order like that. So either case, now the Swiss National Bank at least hiking rates. So we'll see how that goes. Additional pressure facing the Federal Reserve, as many saw last week, mortgage rates really surged again. And we see hitting the highest level since 2008 with another rate hike, not only next month, but still a lot of Fed officials calling for rate hikes throughout the rest of the year. That would continue to put more pressure on the mortgage market. Saw last week, there was at least one day where the mortgage-backed security market went no bid. And when you remember that it was really the mortgage trouble that led to trouble in the banking sector and caused Ben Bernanke to implement these policies, certainly something to keep an eye on there. In terms of other developments that will be affecting these financial markets, here you see Russia fast tracks its central bank digital currency, digital ruble, to be used in real operations in 2023. I won't go through this whole article here, but just to point out that whether it's them backing the ruble with gold, discussing backing it with other commodities, here they're announcing they're accelerating the rollout of their central bank digital currency. So again, another step of de-dollarization. And who knows what else they have planned? You can guess or speculate, but at least that is what they're announcing there. And here you see the Russian oil boycott has failed because the West, they thought they'd cripple Russia's economy when they stopped buying Russian oil. Yet gas prices in the West are on the rise and at unsustainable levels. Meanwhile, Putin is having the last laugh as he is now selling more oil at a higher price point. This was from Armstrong Economics. When Biden initiated these sanctions, where it's one thing to do that from a position of strength, although as fragile as the US economy currently is, despite the proclamations of strength from Jeremy Powell, Joe Biden, and Janet Yellen, we're seeing when they take away the printed money, the NASDAQ down almost 30% from its highs back in November. And the boycott not helping things, because here you see the spike up there. That was the initial reaction, and the ruble was getting blown out. Although now you can see it's strengthened even further. CNBC marking it at 56 rubles to the dollar. So less rubles to the dollar means the ruble is rallying, and certainly as it's being backed by commodities and hard assets, is more than the Federal Reserve has behind their dollar, which I hear estimates now 70% of the dollars in existence printed in the last 2 years. Meanwhile, Russia saying our product, our rules. Russia sends alarm bells ringing over Europe's winter gas supplies. As pre-summer heat wave hits Western Europe, policymakers in the region are scrambling to fill underground storage with natural gas supplies before it gets cold again. Fears of a severe winter gas shortage are driven by the risk of a full supply disruption to the EU, which receives roughly 40% of its gas via Russian pipelines. So that's another one of those parameters that is impacting the resolution. You've seen reports of Europe still buying Russian gas products. I think I even saw a report of Joe Biden trying to get around that as well. And when we had Rand Gabrielli give us our last Russian-Ukraine war update, he said that a lot of these things that the politicians are saying in their proclamations, and they're finding loopholes to get around them. So they're still buying Russian oil, but now they're just paying more for it. So again, the economic law of unintended consequences, where you usually get a lot of blowback to these things. Here you see Russian gas to Europe to stop. The Russian EU ambassador has informed the EU that gas will stop through the Nord Stream because a turbine that was needed was stuck in Canada because of the sanctions. So that's the challenge of sanctioning a country that has leverage, which is not by any means to say that Putin is a nice guy, but in terms of the economic impact, that's what you're seeing there. Although in one dynamic of this war that, again, is not to defend anytime things resort to war or killing, I just have been maybe not shocked, but found it significant that you have things like this 8-year CIA program helped provoke Russian invasion. CIA paramilitaries had been training Ukrainian forces on the front line of the Donbas war against Russian-backed separatists since 2014 and were only pulled out by the Biden administration last month. Keep in mind, this article's back from March. So this is from a couple months ago, but a former CIA official said the US-based program was training an insurgency and taught Ukrainians how to kill Russians. And then the invasion happens shortly after these guys are pulled out, and then you have sanctions, which to me just indicates pretty unfortunate set of circumstances on all sides involved, and can only pray for some sort of resolution to that. Quick note here, I thought this was interesting. On the St. Louis Fed site, they have the average price of eggs as measured in Bitcoin. Interesting to see that on the Fed site. We hear them talking about their own central bank digital currency. Nothing official yet. And again, kind of leaving their citizens in the dark, as the US central bank and government establishments often do. Though speaking of Bitcoin, as I'm sure many are aware, there has been quite a sharp sell-off. Bitcoin was in the 60,000s and had dropped under 20,000 over the weekend. Here, as of Sunday night, we have 19,842. So the price dropping quite a bit there. I know some feel that the cryptocurrency market has taken away a lot of money that may have otherwise gone into the gold and silver markets. I've heard some suggest that that was, in fact, part of the intent behind the inception of the crypto field. I don't know who Satoshi is, so a little hard for me to offer more than a guess there, but certainly if money is flying out of the stock market, the bond market, and the crypto market, that silver market's sitting there pretty small, and would be interesting to see if some of that flocks into silver at some point. So just hope everyone is investing responsibly, and quite a sell-off in the crypto market. And before we wrap up, just like to pass along a note from Sierra Madre Gold and Silver, who's advancing some projects into production. They brought us tonight's video, so thank you, Sierra Madre. And here, recent drilling update as they intersected 32 meters of 1.05 grams per ton gold equivalent during the maiden drilling program at La Tigra in Nayarit, Mexico. Very close to where I was living last year in Mexico. And we have a quote from Greg Liller, who you've seen a couple times on the show. He was back there a few weeks ago when we were discussing the silver supply gap. And he says, these are the first holes drilled in the district, and thus far we have hit encouraging shallow mineralization in all of them. Particularly impressed with hole 3, intersecting 32 meters of 1 grams per ton gold, as they had estimated the overall El Tigre mine zone to be somewhat narrower in the range of 10 to 12 meters. So holes 4 and 5 are currently away for assay, and holes 6 and 7 currently being drilled. You can click in the link below in the description field for the full press release there. Again, thanks to Sierra Madre for bringing us the video, and thanks to everybody for watching.